Over the last 2 decades, Mastercard stock is up roughly 13,000%. This is a tremendous return. I'm generally a believer that winners keep on winning. And so the fact that Mastercard stock is roughly flat, maybe up a little bit so far this year, it made one of my subscribers ask, Daniel, is Mastercard potentially cheap? In this video, I'm going to provide an overview of their business model, my thoughts on Mastercard, and where it potentially goes in the years ahead. Overall, my conclusion is that I like the setup. So if you don't want to watch the whole video, my conclusion is that it passes the unrivaled investing checklist and that there's a good chance that it outperforms many companies in the years ahead. So I'd probably give it my thumbs up as I look at it. It's certainly not a dirt cheap stock, but I'd argue it's probably fair for a company of this caliber. So let's dive in to understand what's going on with Mastercard, a framework thinking about it in the years ahead. This is the hypothetical framework from Flash. I'm a co-founder of Flash, leveraging the most cutting edge AI models available. And it's saying, look, over the next 5 years, maybe it's slightly better than break even. Maybe it's closer to 200% upside potential over these next 5 years. I'm going to talk about a more simplified framework, to think about it, but I'm largely in line with that perspective. So then you have, major smart, shrewd investors that are making sizable bets with Mastercard. You can see Chuck Acri Capital, they've owned around a 20% position in Mastercard for some time. Valley Forge, you have Guy Spears Fund owning around 10%. So a lot of shrewd investors saying, yeah, of course, this is an incredible business delivering outsized returns. I want to align that with my journey. So let's take a step back to understand, what does Mastercard do, its business model. So what it isn't is it's not a bank. It's not issuing credit cards. It's not lending money. It's not setting interest rates, but it is providing this critical network hub where cardholders, merchant acquirers, card issuers can all sort of connect together and move the money around. When you think about the business model, it's really a toll road, the core network business, and then there's services. We're going to talk about both of these. And it's about powering the money so that way it's easy for the merchant to receive the funds from the cardholder, where the cardholder can easily get the capital borrowed from the cardholder's bank, and that the cardholder, can easily transfer those funds, and then you can have the merchants easily accept those funds. That's what this is all about. And when you're looking at the fee structure, let's say there's a $100 purchase, the merchant will receive about generally a few percent off. Personally, for every subscription, I see this firsthand with my payment processors where I see, oh, here's PayPal taking several percent cut. And, this is largely the framework, is that the merchant never actually receives the full percentage. What they'll receive is a fraction. So it's probably around somewhere between 95, 97% that the merchant receives. And then the rest is effectively fees paid by the merchant. The merchant never actually pays it out. It's just the merchant never receives the capital. And most of the fee goes to the cardholder's bank. They're effectively taking a risk on the consumer that's saying, hey, I trust that you're actually going to be able to, pay this loan. And then a large chunk of the fee also goes to the merchant acquirer that's running and processing these fees. And then also Mastercard's taking arguably the smallest chunk, the network operator, to make sure, hey, everything's running smoothly. It's the smallest of the different fees when you're looking at this structure. And this is roughly how it goes. You could argue the arrows might point in slightly different directions, but this is directionally right in terms of how to think about who's getting what part of the pie in terms of the merchant fees. It's really a merchant discount rate. And so then that's the core toll road business that Mastercard has. It's a beautiful business model. I love toll roads type of business models because every time someone transacts, every time there's a merchant that sells more goods, every time a merchant has to raise prices, that is all flowing to Mastercard across their toll road. So I love that sort of business. Beautiful business. Not surprising to see several smart investors say, hey, I want to own it as well. Then you look at their value added services. This is a lot of different buckets. You have cyber and intelligence, data and services, open banking. The way I would look at this to understand what's going on, with this offering is it's primarily Mastercard saying, hey, we have this very powerful tool. We have this very powerful pipe where we see everything that's going through it. We also know that it would be helpful for the merchant to have insight onto how they can run their business better. And maybe also providing data about fraud management more broadly. We've noticed this pattern across this whole network. You're going to get insights from the higher up view, the bird's eye view, that you wouldn't be able to get from outside it. And so that's really what this is about, all these different services. And it's largely been through acquisitions where MasterCard says, it would be good for us to buy this business. It would be good for us to buy that business. So it's been a growth through acquisition, figuring out, what are different tools that we can then offer to our customers, to these merchants, to effectively increase our value proposition, make MasterCard more of a win-win. It's not just a drag on, let's say, the merchant when you have a better understanding on how, let's say, the end consumers are spending, or maybe a way to get them back into the door. So these are important data points to understand when you're thinking about the business. So it's not all the card network, it's not all the payment network, even though that's a critical part of this business. That is around, 60% of this business, and it's growing around 10% plus. You also have the value-added services, which is growing around 20%, and that's about 40% of the total revenue. This is from their third quarter, and you can see this is just it's an incredible business. The adjusted margins are around 60%. There are very, very few businesses that have this type of operating margin, this type of just pure profitability. It's a cash cow. Now, there are some challenges that, MasterCard faces, one of which is the switch to government rails. And let me elaborate what that is. And that's a sort of an infographic I tried to create that goes through some of these key issues, which is that in the US, as you think about, or Western countries, as you think about the exposure to MasterCard, I would say it's pretty stable, where, it's pretty ingrained in consumer behavior. It's pretty, locked in with merchants and the banks. But you have some emerging, markets like Brazil and India, where they might say, why would we want to give Visa or MasterCard this rail? Why would we want to let them in? Why not? Why don't we create our own sort of government-sponsored rail that's pretty much the same thing? So instead of Visa and MasterCard owning the road, why don't we create our own? And in case of Brazil, it's something called Pix, instant transmission. It's effectively disrupting the legacy model. Now, this is difficult to, let's say, expand beyond Brazil's borders, but you do see players that say, okay, well, if this is going to be the new business model, where it's not Visa and MasterCard, it's going to leverage Pix, there are some very shrewd banks that say, we can figure out a way to do the merchant acquisition, to do the lending, that maybe it's credit by Pix, for example. And one of my top holdings is a company that's leveraging this tailwind. So I would argue it's not perfect for MasterCard. It's a beautiful business model, but there are some real challenges, such as individual markets where the government might say, you know what, we don't want you. We're going to come up with our own solution. And that's what we've seen. India, Brazil, China. Another potential challenge is Capital One, a card issuer, recently acquired Discover. Discover has their own network, much smaller than the MasterCard rails. But what's likely going to happen is that Capital One is going to shift all of their card transactions from MasterCard to Discover over time. And so that, will create a headwind, probably a small, not a transformative headwind, but it will create some sort of growth pressure for MasterCard in the years ahead. That's what I would expect. I think they've announced that they're starting to switch over their debit cards, which are generally much lower fee structures. And then you're going to have the much higher margin credit cards probably come in the years ahead. So that I would expect to be a headwind for MasterCard, not a transformative problem for them, just something to consider. Another key aspect that investors need to think about with MasterCard is that it is tied to consumer spending, economic health. A lot of people have talked about sort of a K-shaped economy where really everything that's doing well, the K that's going up is AI and the high-end consumer. And then everybody else, the bottom 80% of the economy, is sort of struggling. And, that's if you have, let's say, an economic contraction or even deflation, that will directly impact, not surprisingly, MasterCard's results. Fewer transactions, lower dollar figures, that's, it would create a headwind. That said, if I think about this business long term, am I really going to bet on deflation or inflation? And I'm more inclined to believe that there'll be money printing and inflation over time, which would benefit a business like MasterCard. So then what's next? How should we think about if MasterCard is on sale? Before diving into that, first of all, none of this is financial advice. I'm just sharing a little bit about my own personal journey, as I think about Mastercard. Also, quick plug, Sam, a premium subscriber, wrote, Daniel, just re-upped my annual subscription after 1 year of being in the community. This subscription has paid for itself many times over. There is no doubt it is a worthwhile investment. I'm 20 years old, sophomore finance and econ major, and can confidently say I've learned more about investing and analyzing companies from your videos and this community than I have in the classroom so far. So if you're looking for compelling ideas, come check out Unrivaled Investing. So as I mentioned earlier, I run all companies, all prospective ideas through the Unrivaled Investing checklist. I prefer management. Management alignment is critical. I prefer founders. I want obvious growth potential. I want a compelling valuation, and I want limited blow-up risk. So let's go through each of these dynamics. When we think about the management alignment, you can see the CEO is getting annual compensation of around $30 million. And the stock that he owns is worth around $90 million. So in short, you have a hired gun. My chief concern with these types of situations where I don't feel like it's tremendous skin in the game. Yes, you could argue $90 million is a lot, but relative to your annual compensation, which is heavily skewed to stock awards, you can see that here. It just makes me feel like there is always going to be a risk with hired guns that they're going to be more willing to pursue an acquisition that might not make sense. That is the risk, in my opinion, or just poor capital allocation policies, because it's not their baby. They're hired to make sure, the trains run on time, keep growing up into the right. Sort of, that's how I think about hired guns. Mercenaries, not missionaries. I prefer the I prefer the missionaries that have some sort of missionary zeal, as I think Paul Simon would say. And so thinking about how do you get around this aspect? Because so far you might be saying, wait a second, this doesn't strike me as management alignment. The way you get around this is to understand, well, a lot of companies, as they grow up, they can't have their founders with them. In this case, this was sort of amalgamation from several banks. So you're not going to have one single founder, I believe, running this. And so in this case, if you can't have that spiritual founder that's driving the company forward, I want at least a management that says, hey, we're going to treat shareholders fairly, and we're going to give nearly 100% of our profits to shareholders. And that's what you're seeing. You're seeing in the past pretty much all their cash going back to buybacks and dividends. Now, you might argue some of these buybacks might be dumb, as they're done at high valuations, but at the very least, it's a way of management saying, yeah, the free cash flow is going to you. So there's not much more we could do, to sort of juice your return. So that's why I'd say, yeah, you do have that management alignment, or at least it passes that, because they can't do more than 100%. I mean, you could borrow, but that's not sustainable in terms of returning capital to shareholders. So then next up, let's think about this valuation, because I would say growth strikes me as obvious. I think there's a good chance, particularly in Western countries, that, people can travel abroad. They can still use their credit card. It's very easy. I think long-term, the economy keeps growing. You have inflation, GDP keeps growing, especially nominal GDP, in which case Mastercard is likely still winning. And then there's also probably some sort of trend, some sort of secular beneficiary as well, as you have the transition from cash to credit, the digitization of the economy. So I look at that and, these are all the tailwinds that make me think the range for Mastercard's fundamental growth in the years ahead wouldn't surprise me if it's, let's say, 7% on the low side and let's say 15% on the high. Sort of, that's how I'm mentally thinking about it for the next decade type of growth. And we'll get back to that in just a second, why that's important, as we think about the valuation. So as we look at this is a high and stable margin business. Because it's a high and stable margin business, you're not going to value this on a price to sales multiple, arguably. You're going to value this on a price to free cash flow multiple. And in which case you could see over the past decade, it's actually low, near its low, not at its low in terms of valuation. You could see previously closer to the 2016, 2017, it was probably closer to 25 times, but now it's around 28 times free cash flow. The reason why that's important to understand is when you're at sub 30 times, always you could do the quick math in your head, 1 divided by 30, that's about a 3% yield. So if you get to 20 times, now you're talking about a 5% yield. So once again, going to that valuation, if we think the minimum, and this is my guesstimate, I'm open to hearing your feedback, the minimum is 7% sort of organic growth over time, combination of their network and additional services. 7% growth. Layer on a 3% free cash flow yield going to you via buybacks and dividends, that means at a minimum, the potential is around 10% type of return. The upside is that 15 plus 3, so you're closer to 18%. So the low is arguably in line or better than the indices have done over a multi-decade perspective. The upside is that you're crushing it and you're delivering high teens return for the next decade. Now, the challenge is what happens if valuation compresses a bit. Could you have a scenario where it, let's say, goes from 29 times forward earnings and falls to a teens rate? And arguably a big part of the reason why the return for Mastercard has done so well is the valuation has expanded so significantly, where you can see that it's gone from mid-teens to 30 times. So that is a nice tailwind, but it does create this, let's say if there's some sort of recession, you could see in that prior picture that low valuation coincided with the post-Great Financial Crisis. People were wondering, what's going on with the economy. You could have similar dynamics again. There was also, questions about regulation uncertainty in the U.S. and, will Congress sort of dramatically change the game for Mastercard and, cut their fees? Personally, I think the skies have largely cleared there. That's my read on it. Maybe I'm wrong, but I'm looking at this thinking overall, I like the setup with Mastercard. It's not the highest growth bet that I'm looking at or considering. There are other companies that I like. I truthfully, I prefer from my own personal investment journey, I prefer the founder-led stories that are hyper growth. I prefer some of those. It doesn't even need to be hyper growth. If you're just, the founder led where it's like, hey, this is our goal, keep compounding at 15% per year. That makes me feel a little bit more comfortable versus, the hired gun dynamic. That said, as I look at Mastercard, would not surprise me if it outperforms in the years ahead because it really does pass most of this checklist. With the management alignment, the cash flow is going to you as a shareholder via buybacks and dividends. If they were to announce a transformative acquisition, I'd want to revisit that. So then next up is the obvious growth. We talked about that as well, based on the economy, money printing, inflation, GDP, cash to credit, all those dynamics likely to continue driving, growth. A little bit of a headwind from Capital One possibly leaving the Mastercard network in the years ahead. So that's why I'm thinking maybe 7% on the low side. And then lastly is the valuation framework, is that 7% plus that 3% yield, gets you to, around 10%. I personally think I'd probably be more inclined. I haven't really made a finalized decision yet on Mastercard, but I think I'd be inclined to wait for 25 times. That's at least my behavior. Maybe I'm wrong. If you look at most of the past decade, it hasn't been there, but there have been some times. And at 25, you get that 4% yield versus 3. And so 4 plus 7, then you're already at a teens rate, sort of at a minimum. So that makes me feel a little bit more comfortable. Then you have, hey, what if, valuation compresses further from here? And I think I would feel comfortable with that scenario. So I hope this video, walking through Mastercard, my thoughts on, the setup from here, the fact, their business model, how I'm thinking about it in the years ahead has been helpful for you. If so, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for watching Unrivaled Investing.